Okay, Chapter 9, Plant Assets, Natural Resources, and Intangible Assets. These are all long-term assets, and the focus of the chapter really can be identified in three pieces. One, the first part of this, we're going to establish what the cost of plant assets are. The cost. We're going to learn there's a number of things added into the cost of plant assets. Next, we'll look at how these assets are written off or depreciated over time. Accounting wants to spread the cost of these assets over the period of time in which the assets are used. The third element will be, well, sooner or later, we purchased the assets and established the cost. We've written them off over the life of it, and in the end, yes, there's going to be a disposal of some type. They're either going to turn into junk or maybe we're going to sell them, one of those options. So that'll be the focus of this chapter. So plant assets. What are plant assets? They're long term. They can be a number of things. It can be land, equipment, furniture, vehicles, buildings. A wide variety of things can be identified as a plant asset and recorded as a plant asset. There's a few exceptions in here. Land, undeveloped land, okay, where we're not going to put our building on or something like that. Okay, it's not a plant asset. That would be considered to be an investment. We know from the cost principle in an earlier chapter that plant assets should be recorded at historical cost. Now, what does that mean? It means the cash plus, say, a promissory note. But in addition to that, there are some other costs of acquiring these assets that need to be added into it, added to the cost, the capitalized cost. We see here a list. If it's a land acquisition, yes, of course, the purchase price is included in the cost of that land, but also commissions, surveys. Get this, if we purchase land that has delinquent property taxes, when we buy that land, do you know that it's up to us to pay those delinquent property taxes? When that happens, you know what we do? We increase the cost of the land that was purchased. The same with each of these. In other words, what we're saying here, land improvements, buildings, vehicles, equipment, machinery, and furniture, into these types of assets, these are typically the kinds of costs that would be added to it. So for example, let's just make us a journal entry. Let's say we buy land. I'll make it on the side here. Land for $1,000. Well, we got a good buy. Credit cash. Just decided to pay cash for it. Small piece of land, that's for sure. Now, if that land was subject to, let's say, delinquent property taxes, Bexar County delinquent property taxes, and we cut a check for $80 to pay off old taxes on that, capitalized means we're going to increase the cost of that land $80. And let's say we paid cash to $80. So when we write a check to the Bexar County Appraisal District or tax collection agency, when we cut that check, we'll credit cash and we will debit the land account. This is an example of how we add the cost, capitalized cost. There are some instances where we have an extraordinary repair. I think of an 18-wheeler. If we owned an 18-wheeler and after a million miles, we decided to do a major overhaul or add one of those sleeper cabs to the back of it or something, that would be an example of us increasing the efficiency or extending the life of that vehicle, and that would be considered an extraordinary repair. Most repairs are this type, the ordinary repairs, broken windshields, um, broken headlights, those sorts of small things, those are going to be expensed. New tires, they'll be expensed. Okay, let's look at an example. What we're going to do is follow the rules that we established on the previous page about what is to be included in the cost of the asset. So I've given some facts here and identified the type of expenditure that's connected with it. And so I'm asking you to follow along right now. At the end of the day, the cost of the land, the total debits to that land account, with this set of facts, we can see it should be these items right here added up. The cost of land improvements and the cost of the building. So follow through on that and check those numbers. Depreciation of plant assets. When an asset is purchased, okay, let's say in this case a $50,000 machine is going to last 5 years. Okay, before we get into the details, what we're attempting to do here is say if that's a $50,000 machine, it's going to last 5 years, we want to spread that cost across the years that it's being used so that every year it gets hit with its fair share of depreciation expense. We use an account called accumulated depreciation. We'll see in the journal entry just below. We've seen it before. And the book value. Here's the cost. Look how it's reported, less accumulated depreciation on that machinery, and $40,000 is the book value. The concept of depreciation and making that adjusting journal entry, we first looked at in chapter 3. Okay, so you want to review that. You may want to review that. Here we go. And here's the journal entry. This is not new. This is from chapter 3, depreciation expense up, and this contra asset account accumulated depreciation up. Now we're going to learn in chapter 3, we didn't do any calculations. We were just given the number. Now we're going to learn the 3 most frequently used methods to calculate the depreciation. Straight line, units of production, and double declining balance method. This is by far the trickiest. It's always been that way. When I took accounting 1, I found it to be the most difficult, and I imagine you will too. Okay, there's 3 important things for all of these methods. What's the cost? How long is it going to be used? What do we think that the life is? And what do we think it's going to be worth at the end? Salvage value or residual value? Now this is important because remember, what we want to do is spread the cost of that asset over the life, but if we buy it for a certain amount and it's worth quite a bit at the end, well, it's not going to be completely used up, is it? This residual value means it has value at the end, and that needs to be considered in our calculations. Okay, straight line method. This is by far the easiest. This is the one that everyone loves. You take the cost minus the residual value and then divide by the number of years of useful life. You'll always be, in these calculations that we're doing, you're going to be given the cost, you're going to be given the residual value, and you're going to be given the number of years of useful life. Now that's for a full year. If an asset a depreciable asset is used for just a fraction of a year, then you just take a fraction of that year. For example, here, the first year, if we buy it during the year and only use it 8 months during that year, we won't take a full year's depreciation. We'll just take number of months used divided by 12 months. The second method makes a lot of sense to most people. What you do is you take, look at the, right here it is, the cost. Step one, you take the cost minus the residual value. You're going to be giving both of those, and the estimated life. Now this is going to tell you the rate per unit, per hour of usage, if it's that type of machine, something like that. It's going to tell you the rate per unit. And then step two, you just look for, and you're going to be told, well, how many hours, for example, was an asset used on a particular year. This type of asset, typically a high-tech machine, it's probably got a gauge on it that monitors and reports the hours of usage, and that units of usage will be given to us everywhere we need it in this chapter. We'll practice on that in a minute. The double declining balance method, the least favorite. And you can see why. Multiple steps to this, and some of them are rather tricky. Let's look at it. The overall equation is cost. This is every year. Cost minus accumulated depreciation times a declining balance rate. They call it double declining balance because it's double, twice the straight line rate. That's the double part. And then the declining balance element of that is you're going to see that the book value balance is constantly declining. And each year it'll change up our calculation. So step one, figure out that the straight line rate, which will always be given to you, and then double it. Then use the formula, and this accumulated depreciation going to be constantly changing on us, okay? So each one of these years we'll take the cost minus the accumulated depreciation as of the end of the previous year times that double declining rate that we calculated up in the previous step, okay? And just like the others, if it's not the others, straight line method. Straight line method and double declining balance method, same thing. If you use it just part of a year, then you just take part of a year in depreciation. Okay, the numbers will probably answer a lot of questions for us by doing an example. So let's look at an example. A company purchases industrial sewing equipment January 4th. That's wonderful, isn't it? Because it's early in the year. We're going to get to take a whole year's worth. We don't have to split it as a partial year. They buy it for $67,500. It's got a useful life of 3 years. And look at this, operating hours. There's only one of the 3 methods that uses this hour. You ignore this information for straight line and double declining balance method, but the units of production is where we use this information right in here. Okay, okay. Oh, look at this residual value. We need that. We've got the life 3 years. Okay, so let's take a look at the set of facts here and put it into our table. If you look at this table, date, asset cost, there it is, $67,500. Depreciable cost, let's make a note right now. What is this number? This is the asset cost minus what? The residual, $67,500 minus the residual $4,500. That's how much we believe it's going to go down in value over the 3 years. Here's the formula. Okay, asset cost minus a residual value or salvage value divided by the life. That's what the formula says, 21,000 a year. So for the first year, 21,000, depreciation expense up, accumulated depreciation up. The book value, cost minus accumulated depreciation equals the book value. Year 2, straight line, nice, right? Same calculation, same amount. Accumulated depreciation accumulates or grows. It keeps track of the total depreciation we've taken. The book value, 67,500 minus 42 equals the 25,500. The last year, another 21,000. Accumulated depreciation now gets up to 63, and book value, in the end, the book value has to agree with the salvage value or residual value. 63,000, that's what we take over the life of it, and that's what we believe the decline in the value of that asset will be. Using the units of production method. At the top of the page, we have the details about the usage and the total hours. Step 1, as we learned on the previous page, take the total cost minus the residual value divided by the total life expectancy of this piece of equipment. When we do that calculation, we come up with $2.52 per hour. For every hour we use the asset, we think it's going to go down in value $2.52. Notice that our looks a little different than the straight line method, doesn't it? Here we've got the depreciation per unit. That's the 252 we just calculated. Now each year, we've done the tough part. Now it's easy. Well, how many hours did we use it that first year? 10,000. Okay, we'll do the math. We'll take 25,200 in in depreciation expense, and accumulated depreciation will go up 25,200. Book value. Second year, you're using that same rate. Well, how many hours did we use it that second year? 11,000. You do the math. Depreciation. Book value, same, 67.5 minus the 52,920, book value. But last year, how many hours? 4,000. Notice, it's a sort of a check number for us. Got to end with a book value equal to the residual or salvage value. Notice that we take a total of 63,000 over the life of it. That's what we believe the decline in value is going to be, but because we used it different amounts of time each year, the annual depreciation changes. The trickiest one, double declining balance method. Let's look at this. We start with the cost. Notice here, okay, we're starting, this is not reduced by the residual value. Look at the formula. It doesn't say, the first two, straight line and units of production, mentioned it, but in the double declining balance method, we do not reduce the cost amount by the residual value in the beginning. We take the full enchilada, 67,500 times, remember it's twice the straight line rate. 3-year life would be 1/3. You could put 33.33% if you wanted, but it's twice that straight line rate. Wow, look at this, $45,000 the first year in depreciation expense. Now that's rapid, that's accelerated, isn't it? It's not evenly spreading it, and it's not based on usage. One way to look at this method is, I don't know if you've ever purchased a new car from a dealership, brand new car, but when you drive it off the lot and you go down to the first stoplight and you stop, you know what you got? You got yourself a used car. And the value goes down rapidly in the beginning. Used car decline in prices is significant. Anyway, that's an example. Here's $45,000 the first year, accumulated depreciation 45, book value. Now, here it comes. You see this end of the first year, okay? This book value, remember double declining balance, declining book value balance. This 22 end of this year is the same as the beginning book balance of book value of this next year. And that's what we use in the calculation. Beginning book value times twice the straight line rate, 15,000, goes up to 60. Book value comes down to 7,500. And then certainly the trickiest of it is in this last year. In this last year, 3-year life, if you were to go right along and do the same thing the last year, you'd take this 7,500, right, and put it over here. You'd take 7,500 and you'd go through the calculations. But you know what you'd find? You'd find you came up with the depreciation too much that last year, because you can only take the amount of depreciation that last year that you need to get that book value down to 4,500. Now, and of course, as we expected, 63,000 would be the accumulated balance, accumulated depreciation balance at the end of this third year. In the end, we know all three methods, 63,000 is the total depreciation we'll be taking on the asset. And as we learned in chapter 3, and it's noted on page 1, make that page 2 near the bottom, the journal entry. Debit depreciation expense equipment. If it's equipment, if it were furniture, you'd put dash furniture. Accumulated depreciation. Debit the expense to increase it and credit the accumulated depreciation. Now, as I mentioned, sooner or later, you're gonna dispose of the asset. You're going to get rid of it one way or another. Sooner or later, it's going to wear out. Now, as long as you use it, let's say you depreciate something over 3 years, and after 3 years where you're still using it, you just stop depreciating it. You'll leave it on your books. You'll leave the asset there and the accumulated depreciation. You're going 6 years into it. My gosh, this thing is still operating, this machine's still going strong, whatever. You just leave it there until such time as it blows up or you sell it. Okay, so here's an example of an asset. And well, let's make this point right here. What you've got to do when you dispose of or sell any of these fixed assets, remove the cost and remove the accumulated depreciation. Keep that in mind. Next couple pages. So here's an asset. $10,000 is what we paid for it, the original cost. We've had it a while. The accumulated depreciation balance is also $10,000. We've fully written that off. Now, and recognize here, there must not have been any salvage value or residual value. These are estimates. If we don't think it's going to be worth anything at the end, then there's no requirement to use a residual value or salvage value. In this case, we didn't believe there would be any, and now we've used it. So we've got what we've over here, and I'm just going to abbreviate this. Let's just put equipment. Right now, that balance sheet depreciation, here's the asset cost, 10,000, and then I indented a little bit, accumulated depreciation, $10,000, okay? Like this, and has a zero book value. A debit to equipment. I really squeezed that in there, didn't I? And accumulated depreciation has a credit balance of 10,000. That's what we're saying. That's That's where we stand right now. If we send it to the junkyard, what do? Remove the $10,000 from the equipment account and remove the accumulated depreciation, which is going to have a credit balance. Remove that with a debit. If it's not fully depreciated, then what you got to do, well, wait a minute, getting ahead of myself here. Okay. Well, look at this. If it's not fully depreciated and it's junk, when it's junk, you send it to the junkyard and remove it from your books. In this case, it didn't last as long as we thought. It's junk. The original cost is this. The accumulated depreciation is 20. Remember the rules. Remove the asset. Remove the accumulated depreciation. And of course, then you notice the entry doesn't balance. The only thing in the universe that can cause this entry to balance, and you know that debits must equal credits for each transaction. This $5,000 balances this journal entry. And look at this, a loss. You could think of it as an expense because a debit to the loss is an expense. It's a loss. We just go, well, it wore out before we thought it was going to wear out. And you know what? We're going to take $5,000 loss this year, the year of disposal, all at one time. If we sell an asset, we've got several steps we go through. And I'll go through this quickly. But what we do is we could sell it. We'd put something on eBay. Maybe we're going to get the new model coming out. We want to dispose of it now. It's still working. It's fine. What we'll do is we'll take a portion of the year, however many months we've used it this year, we'll take depreciation up to that point. Then we'll follow the rules, remove the asset, and remove this new accumulated depreciation. After the update, we'll remove that from our records. Then we're selling it for something. We'll record the cash received. If they owe it to us, of course, it'd be accounts receivable, but let's stick with cash in this example. When we get the cash, we'll reflect the cash. Then we'll record, just as we did above, a gain or a loss. So here's an example with the facts. 50,000, 5-year straight line residual value, 5,000. Okay, so this is straight line. Cost minus residual divided. 9,000 a year is what this asset will be depreciated each year. And after 3 full years, okay, 27,000. And then July the 1st, 6 months into the current year, we sell it for $20,000 on eBay, for example. What do? 9,000 divided by 2, half a year, right? This last year, the first thing we do is take a half a year's worth of depreciation expense up, accumulated depreciation up. Take that half year. Now, let's see, where was that balance? There it is. We had a $27,000 balance. Now we've got another $4,500, and now our accumulated depreciation balance is $31,500. Let's make the journal entry. Follow the rules. Remove the cost. Remove that accumulated depreciation balance. Reflect the $20,000 cash that came in. The entry doesn't balance at that moment. In order to balance this entry, the only amount possible here, $1,500 debit, and this is a gain. The book value of this asset, the book value is what, 50,000? Let's see, the book value of 50,000 minus accumulated depreciation 31,500. That's 18,500. That's the book value, 18,500, and we sold it for how much? 20,000. We've got a $1,500 gain. Anything we sell it for above the book value is a gain on the disposal. A gain will always be a credit. I used to remember it just as a gain is like revenue or something. Increase it with a credit. If we were to, it was a slow day on eBay and we only got 18,000 for it, ouch. We apply the rules, 50,000, remove the asset, remove the accumulated depreciation, just as we did above. How much cash? Only 18,000. Show the cash coming in. When you go through that, well, you can see the entry doesn't balance. The only thing in the universe that we can do to balance this entry is put 500 here as a debit, and it's going to be a debit. It's a loss. This book value, 18,500. We now sold it for 18,000. Sold it for less than the book value. We've got a $500 loss. Okay. Let's move on. Natural resources. Natural resources come from the ground. Special set of rules for those called depletion. We're going to take depletion expense. It's similar to depreciation, but when it's a natural resource, we're going to call it depletion. Depletion is always to deplete a natural resource. To write it off, we're always going to use the units of production method. Here's an example that'll I think make sense of that. We buy the rights to a mountain up in Montana. It's got all kinds of iron ore in it. Maybe it's owned by the government. We're bidding on it, and we wound up getting our bid. We bid 500,000 cash just for the rights to go dig that iron ore out. We still got to have trucks and the men and women and fuel and all the expenses connected with removing it. We're just paying for the rights to go carve it up. And the reason we bought it is because our engineers figured there's 2 million tons of ore in that mountain. So the first year of operations, the trucks move. As the trucks leave the site, of course, we've got somebody logging everything. You've probably seen them. They got a clip pad, clipboard, at the exit, and they go through and they identify how many tons from each load. We identified 450,000 tons removed that first year. Well, the question is, what would be the depletion? So let's look at it. Here it is. Here's where we acquire the rights. Iron ore. It's going to be an asset in the natural resource category. 500,000. Asset up, cash down. On to page 7. Here's our end of the year adjusting journal entry. We're going to debit depletion expense instead of depreciation. We're going to credit accumulated depletion. Now, how do we get this amount? Remember, we pay 500,000. We think that it's 2 million tons. Basically paying for the rights to get it at 25 cents a ton. How many tons did we haul out? 450,000 tons. Okay, times 25 cents a ton, $112.50. This is how much of the 500,000 rights, this much. Now, look what we do. Take an expense. We want every year to get hit with the depletion expense of that, based on that 500,000, spreading that 500,000. And here's the end of that first year. Contra asset account, accumulated depletion, book value. Okay. Intangible assets. I'm always watching the time here, 35 minutes into it, close to 35 minutes. Try to get this completed in a good fashion for you. Another 4 or 5 minutes. Intangible assets. Can't see them, feel them, taste them, or anything else. Okay, they're valuable. They're assets. They're intangible. And when we spread intangible assets, we call it amortization. Amortization. So when there's patents, my father got several patents. All they wound up doing was sending a lot of money to patent attorneys in Washington, D.C. to do research. Never did get anybody to buy them, but he got those patents. Okay, here's a case here. Writing off a patent over 5 years, a cost of $100,000. The asset account patent, intangible asset goes up, cash goes down. On a straight line basis, $20,000 a year. Okay, page 8, copyrights and trademarks. A copyright, we consider this, all of these are considered intangible assets. Intangible, look at this. The rights to a book. Hold on, look at this. Plus 70 years, the rights. Okay. Movies don't last very long, have a short shelf life. That's why you get the movies at for $1 or $2 after a few months after a movie's released. Trademarks like the Goodwill. Goodwill's interesting. Reminds me of AOL, America Online, back in the day, many years ago. I believe it was Time Warner thought that AOL had the rights to the internet or something, and they purchased AOL. AOL had like $3 billion in assets, and they paid $57 billion. They paid $54 billion more for that company than the market value of its assets, minus any liabilities they had. $54 billion of goodwill. They thought they really had it, really something wonderful. Why does somebody pay $1 million for a McDonald's franchise when you only get a $400,000 building out of it? Well, because they've got the operations down, they've got the support system, they've got a reputation. Here's an example of pizza company. This pizza company, okay, you're wanting to open a pizza company and you find someone wanting to sell the equipment of a pizza company along with the pizza company. Okay, the company, the value of the equipment, $75,000. You've looked at it. Okay, but they've been in business 20 years. They've got a great clientele, a good reputation, and you know what? The owner's asking $125,000 for it, and the owner's saying whoever buys the company needs to pay the liability. Maybe this accounts payable of USA, pizza supply company, for $5,000. Well, you want to assume that liability. If we were to agree to that, how would that be recorded? Well, we cut the check, $125,000 to buy the business. Here's the assets. Now we would, at the market price, this $75,000, we would break this down into the furniture and fixtures, the equipment, that sort of thing. So we'd have some details. It'd be based on the evaluation we did up here. And look at this. Because we're paying more, and here's the liability we're assuming, going to be probably accounts payable. The missing number here, you're given everything. We know what the assets, the market value is 75. We know that 5,000 in liabilities. We know what we paid for it. The excess is recorded as goodwill, an intangible asset. Let's hope it works out. Hope they've got a good reputation and hope we can continue that. Okay, last thing here, bottom of page 8. Look at this, the income statement. Okay, of course, disclose, yes. Disclose the method used, and now you know that based on the method, significant monetary difference between the various methods. And of course, these gains and losses that we talked about in this chapter are going to be reported on the income statement. So, saying ignoring income tax expense, it's an expense. Future accounting courses, you'll see that tax expense come into play. So our condensed income statement here, revenue minus cost of goods sold equals gross profit minus all of our ordinary operating expenses, rent expense, utility expense, all of those expenses gives us operating income from operations, and then plus any gains we had from selling off equipment or any losses that we incurred from selling off equipment. That gives us net income. On the balance sheet, know that we've got these categories: natural resources, after plant assets, that's taken. Okay, that's the balance sheet. Okay, that's chapter 9.